Welcome, everybody. Welcome to this edition of the podcast, Crashes and Taxes. I am your host for this podcast, Rebecca Walser. Super glad for you to have joined me today. This is my passion and my love. What's going on with our society, our economy, our country, our constitution, our laws, our freedoms. This is the passion of my life, besides economics. You know, I am in love with economics because economics is the marriage of math, business, and the law. Economics is phenomenal. If it was a man, I'd marry economics for sure, but I can't. So I'm like literally potentially looking at an economics PhD. Things are very busy in 2023, and I love this podcast. I'm going to keep trying to do it with you every single week, but it is what I'm doing for fun, and it's certainly not part of my world of professional advice giving, and it's just fun. So I will always try to do it, but just be aware that this is just me having fun and it's not really part of my professional career. So let's go ahead and get the slides up here today and get this going. Today's going to be more of an update. We've had major things happening. I will start again with my standard thing, which is those who are able to see beyond the shadows and lies of their culture. The shadows and lies of their culture, that's the culture we're living in right now, will never be understood, let alone believed by the masses. So I am putting this out there. This is obviously a Plato quote because I believe that we will continuously get pushback as to what we're saying, not being realistic, not being reasonable, not being right, until last one of you realizes that we've actually been in the know this whole time and that it's just been obfuscated and hidden from the general public. All right. So this week, the big thing obviously is this debt ceiling deal that was reached by McCarthy and Biden on Sunday. And it is a massive potential issue legally that I'm seeing. Constitutional, not crisis level, no, but is it a massive legal issue? It is, because what they have done is in fact they have suspended the debt ceiling. They have not increased it. They have made some concessions around what will happen through 2025, but they have in fact suspended the debt limit through the election, through November 2024, getting all the way until 2025. There is pretty much a freeze on spending or a 1% cap, depending, and there's a 3% increase on military defense spending. Everything else is pretty much either 1% increasing or frozen, but I just need people to understand, if you think that there isn't going to be any kind of laws passed between May of 2023 and 2025 when the debt ceiling suspension ends, it's ridiculous. And that's not the case. So with the absence of a debt ceiling, what is controlling the limits of spending on these congressional bills by Congress? Because we are already at the 31.4 and there's no raise of the debt ceiling. There is a suspension of the debt ceiling. This is a new constitutional question that will raise additional legal issues that right now it's so new. It's not even really being dissected yet in the legal spheres of what does this mean. Prior to this, and we still have to have the Senate agree to this. And literally, I'm recording this May 31st. June 1st is literally tomorrow. Janet Yellen has told us that the X date means the date that the United States can no longer pay their actual bills using the Treasury Department selling additional treasuries, notes, securities to be able to pay bills. So we've been using since January. People are not understanding. We hit the debt ceiling in January. We hit the limit in January. Janet Yellen came out, Treasury Secretary came out and explained that she was going to use something called extraordinary measures or outside measures to continue funding the operations of the government. But she said in January that she thought that would end in June. She came out at the beginning of May and said June, beginning of June, we will be hitting our inability to pay our bills. And so that this deal is that important. We've been threatened by both Moody's and Fitch to downgrade our credit rating in AAA down again, just like it happened in 2011 under Obama. And we got downgraded by S&P at the time, Standards & Poor, and we had billions of dollars of additional interest that was accumulated because of that downgrade. So obviously we are trying to at all costs avoid a Fitch, a Moody's, and S&P downgrade in our credit rating of AAA, and we certainly do not need additional excess interest payments. But there are some legal questions here regarding a suspension of the debt ceiling. And I think that these questions are going to be addressed and issued. I know that if we're looking forward at the Senate and the Senate's ability to approve this, the Senate definitely has some conservatives that have issues, although the Senate obviously is in Democratic control. So there's not too much of a risk that it won't get through, at least on a majority basis. So let's keep going. I want to talk to you guys about shadow banking, because the shadow banking is the NBFIs, which stands for non-bank financial intermediaries. This is a large part of the liquidity of the entire system. So when you think of banking, you think of the traditional bank, but there's a lot of liquidity, risk, and capital that comes out of NBFIs, non-bank financial intermediaries. And so what are these NBFIs? Insurance companies, pawn shops, the check cashing locations, those payday advance loans. Have you ever driven through, a town and you see these like payday advance loan, or bring your check to or bring us your pay stub and we'll advance you your next payday payment. People that are, and it's a really big shame, because these people get into a trap, right? They get into a trap of getting their paycheck advanced, and now it's been advanced, they've already spent it, now they have to get the next one advanced. It becomes literally a trapped pattern of people having to constantly getting their paycheck advanced in order to continue to make their payments. So that's a really big issue. And also the interest rates, right? We've had all kinds of payday lending, truth in lending disclosure requirements legally that have been made, because the interest rates can be outrageous and really what we would call just illegal, just completely over the limit, and considered what we call usury in the law. So currency exchanges and micro loan organizations. So your crowdsource funding, lending, all of these things are the NBFIs that do affect liquidity. And the reason I'm specifically bringing this up, and you can see this right here, shadow banking provides credit and liquidity. Unlike traditional banks, they do not have access to the central bank funding or safety nets like deposit insurance. They issue short-term money claims in maturity and liquidity. This is really a short-term liquidity situation on these non-financial intermediaries. And the thing is that what I'm trying to make the point of here is the fact that we're starting to see now, specifically in China, these NBFIs come into a lot of financial crisis pressure. And that is a shadow banking foretelling of a potential shadow banking collapse starting in China, certainly as they deal with their fallout of how they fund real estate. Now we're looking at negative real estate down payments. We've got a lot of things happening in the underlying non-bank intermediaries that are indicating additional major economic pain for 2023. And the indicators are coming out now. This is hot off the press. And so the second I start to see banking crisis that we've been experiencing, obviously, they've done a very good job of keeping that pretty much at bay and making the entire United States consumer feel like their bank is still safe, even though we still continue to have massive withdrawals from both regional and national MNC banks. We are still in a liquidity crisis. And now that we're seeing the crisis move to the shadow banking environment, and that is now coming to the press, we're starting to see that this is going to be potentially worse than people are prepared for. The world is not prepared for the economic machinations that are actually occurring right now. Now, this is a really interesting Fed chart, and it's got basically advanced retail sales versus the CPI, or consumer price index. So basically, as prices go up, what happens to retail sales? And you can really see we've already highlighted the economic periods of decline. So we've got the dot-com crash here, we've got the Great Recession here, 2008, 2009. We've got the 2011, 2012 pull away. And then we've got right now, present day, 2023. And I just want you to see that as CPI, which is the red, goes up, as CPI peaks, as inflation and prices rise, you see retail sales automatically pull away and fall. And this is really what we're looking for, is the separation gap. How much is CPI causing advanced retail sales to fall? And that gap is a economic measure that we consider, and that speaks to the severity potentially of an economic problem and an economic crisis. So you can see here in the dot-com crash, it was a very relatively minor pull away. CPI goes up and retail sales come down relatively in a minor fashion. Then you can see really here in 2008, inflation starts to really, and the CPI, it has been gyrating. People don't look back at 2008, 2009 global financial crisis and think, oh, it was an inflation driven thing. No, not at all. But you can see that as prices peaked up, you could see the retail sales bigger gap, a much bigger gap than we saw in the 2000 basically in 1-2 dot-com crash. So the gap increased substantially in 2008. But now we fast forward to 2023, and this is it. I mean, whoa, look at this chart. Look at CPI. And of course, we know that we had massive CPI inflation. This is the largest inflation we've had in many, many years, because of the fact that we had two different capitalization events, which we don't talk about. We only talk about one. We talk about coronavirus. But let's not forget that we recapitalized the we recapitalized the investment banking world in the fourth quarter of 2019 to the tune of $11 trillion. So all of this money that has been injected into the system, Q4 2019, 2020, 2021, they labeled transitionary. We were able to get away with that. And then 2022, finally, we had some kind of reckoning, and we are not out of it. This market is top to bottom so mixed up, but yet, my buddy Charles Payne, that I love to do Fox Business with, he was making the analysis to me that if you look at all of the S&P markets since 1920, anytime we've been positive through the first 5 months, it's 99.99% of the time a positive return. There's only been 1 or 2 years since 1920 where we were positive through May on the S&P, and the market actually did go back. However, this, as I told Charles, or relate to Charles, this is not this is not a normal year. And so I hope his analysis is correct and that we have a positive year. But we, of course, are looking at data like this, and we are bracing for not such a thing. This is the Beige Book of the U.S. economy, and I wanted to just kind of bring this up to you guys so you could kind of see the general terms of the United States economy. And overall, everything in the Beige Book shows that we are slowing down, and that even if things are continuing forward, they're continuing forward at a slower pace. For example, wage growth. We have positive wage growth, but the wage growth is slowing down massively compared to what it was speeding up at, the rate of its increase, starting in 2022 as the economy started to really have its issues. So the biggest thing is pretty much the data is boring. Generally, let's just give you the general economic activity for April and May was little changed. We have 4 Fed, of the 10 Fed banks, we have 4 that are reporting small increases in activity, 6 with no change. And then we have, of the 2 others, 2 with slight to moderate decline. So really, we have 2 with declines, 4 that are the same, and 4 that have small increases, but that's just the point. 6 with no change, 2 with decline. So you have 8 to the no change negative side, with only 4 showing small increases in activity. So what this is overall very bearish news in the sense that we aren't seeing any recovery, and any recovery that we have seen has slowed down. And the recessionary indicators through shipping, trucking, freight recession, we're looking for demand for transportation services is down, especially trucking, which is totally related to retail. That is a 100% retail situation, affected by the retail sales forward forecasts. So we're just overall seeing that things are continuing to slow down. Commercial construction real estate activity overall decreased. Obviously, commercial office is now a spotlight as a weak sector in real estate. We're really looking at that in very closely. Farm income fell in most districts, and now we're starting to see energy pricing that's starting to indicate that we will get a decline in actual activity. We're starting to see energy priced to the downside, meaning that we do not expect there to be a lot of economic recovery activity going on this year. One thing that I wanted to mention, I did forget, and I'm going to come back to the slide. The debt limit deal of suspension does reinstate, ironically, student loan repayments. So I think we've been at a pause on all student loan repayments since coronavirus recovery package of 2020, and that has been extended and extended and extended. This ceiling deal ends that, and repayments will begin. So I don't have the date on that yet. Everything is just newly decided, and so it's going to be coming forward. But if you are one of those people that still has student loans, or if you just graduated and you have student loans and you were like enjoying 6 months of no payments or whatever, that is ending. So I want to just encourage all of you to talk to the people that you know that might have student loans, and to let them know that the deal has now changed. The last thing I want to talk about is metals. Obviously, you know that I am a huge believer in both gold and silver and any kind of currency transition time frame, which is where we are. We are globally, and this is so clear to me as someone who reads the tea leaves. But for the general public that doesn't, obviously, for them, it's going to seem like everything is sort of kind of coming back to normal and recovering, and that is so hard. It is so hard for me to do my job and explain to people like the real metrics and the real economics versus the PC, what we put out there on the news. And the reason for that is, you don't want to scare people, but I can just tell you that the world is in the middle of an economic transition time frame. I don't know if it's going to be a 2-year window, a 5-year window. I don't know how long it's going to take for us to really achieve where we're headed, but we are in a transition time frame. And let me just recap for you as I wrap up what is happening right now. So literally tomorrow, June 1st, in June, we have the ultimate changeover of all of the existing debt obligations globally, and certainly in the United States, which the majority are located in the United States, of the London Interbank Offer Rate, LIBOR, to SOFR, which is a difference and is going to be a liquidity-based event that will have an impact. So we have that big transition. And I want to express that transition was supposed to have been done by January of 2022. And when they got to the deadline of January 2022, they said, oh my gosh, there's no way that the existing obligations can also be converted, only new obligations. So they changed it and they said only new debt issuances January 2022 forward will be. And so for all existing LIBOR has to be changed to SOFR by June 2023. They gave themselves an extra 18 months. And here we are at that point. And then, of course, in July, we have the operational launch of the digital dollar and the Fed Now platform. We are launching our central bank digital currency in July in the United States. There are 80 other countries that are doing this similar thing as well this year. So we have big summer economic events that are coming up. The next FOMC meeting, obviously, is in the second week of February. And we already know that the Fed is indicating that there might not be another 25 basis point hike, but there is not going to be any kind of cut or pivot. So what happened, as we know, is the World Gold Council restated their analysis for 2022, as they had originally said that it was the largest purchase of gold by central banks since 1957. 1967. They restated that in February to state, no, we changed it. It is now the largest central bank purchase of gold in the history of the recording of the metric, which I believe goes back to the, don't quote me, but I believe it's 1950s, but don't quote me. And so we know that the central banks massively bought. Then you have Erdogan in Turkey selling his gold. And so you're getting this mixed signal, unlike China, unlike Russia, where Turkey, who is a part of this moving towards these BRICS nations, definitely, and a solid relationship with Russia, selling their gold. Erdogan is having to massively raise capital for what is going on in Turkey right now. The way he's handled the fiscal responsibility of that country is a whole nother story. But I want to explain, because we saw metals, and we saw specifically gold gap down to the 1940s when it was closing in the 2020s, 2020. And yet it gaps down to 1940, almost $100 off per ounce. And as the market is going up, this again, you guys, is a simple matter of when you are in the business of gapping metal prices in order to obfuscate what's going on with the real economy, you must continue to do that. So what you have seen already is, as we're preparing for the market to decline because of this debt ceiling situation, they've already gapped metals down, and now you're seeing metals gap back up. And this is the same pattern over and over and over of them manipulating metals. So in other words, they are aware of economic activities that are coming a couple of weeks in advance. They say this is going to make the price of metals really to the upside because it is an indication of true hard asset value. Remember, they've untethered true hard asset value in metals with all of our financial currencies and all of our financial derivatives. So any kind of indication in the price of metals of what's going on in the economic world is something they must avoid at all costs, because there is nothing that will make people sell out of their equities and bonds and move their money out of their banks and into metals faster than the economy, the stock market collapsing and metals jumping from 1980 to $2,200. You would see a mass exodus and a move to hard assets. They are very aware of this. I have done multiple podcasts on the metal manipulation market and how many executives have been found criminally liable and have gone to jail. This is public knowledge that they can manipulate through LBMA and COMEX the price of metals. And this is very, very, very well economically documented. And so anytime you see gapping down of metals when everything seems like, okay, it's kind of calm, the debt ceiling hasn't been hit yet, and yet metals are coming down, this is in advance of information and events that will be coming that will force the metals up. And therefore, they have to tether down the metals, gap them down in order for them to be able to be gapped back up, so that, again, the market and metals stay really in a tight sphere of trading with each other. Because if you have metals break out, you will have people move out of their financial derivative assets, which are obviously bonds, stocks, and they will move to hard assets like gold and silver. So they can't allow that to happen. So in Turkey's case, yes, they had massive CB gold purchases last year, but Erdogan, with what he's doing with his country's liquidity rate right now, he has sold his reserves. I believe his reserves are now in the negative. Turkey is having major financial problems, and we'll be hearing about that in the coming weeks. So overall, you guys, I would just say that between the X date being technically tomorrow, not having the Senate yet approval, having both Fitch and Moody's threaten a downgrade, having the transfer from LIBOR to SOFR now upon us and having the launch of the digital dollar on the FedNow platform in July, I want you to understand that as we all go into summer holiday mode and the kids are out of school and we can go to the beach and ride the jet skis and the boat, whatever you do for your summer fun, if you're, doing ATVing in the mountains or, on your lake rowing, whatever you're doing to enjoy your summer, I just want you to brace, because the summer is the best time for these economic events to happen because people are so distracted with their vacations and their families. And so it's a really good time for manipulations of economic markets to occur. And so just don't get into the mentality of, I'm not going to worry about this. I want to enjoy my summer. I'll worry about it in the fall. Stay with it, because there's going to be a lot of big developments, economically speaking, in the next 3 months. And I would really prepare a plan for a brace yourself plan, if you will. Brace for what potentially happens. As you guys know, I've told you a million times, it's always a great idea to have some precious metal coins at home, just in case you need them in the event of some kind of economic situation. And, you want to have some food and some water. I'm not telling you to become a prepper. I know there's preppers out there, not good for you, love you, great for you. I'm not saying be a prepper. I'm just saying that the war games have been done and have indicated that the United States would be literally in complete societal collapse and chaos within 7 to 10 days of them closing the grocery stores, because most people only have a 1 to 3 day food supply and have the habit of going to the stores a couple times a week. That's kind of the way Americans, either they're eating out or they're shopping twice a week frequently. And so any kind of disruption of supply chains, of grocery store access, food access that extends beyond 3 days has been war gamed in our country, and has definitely shown that we would be in the massive amount of civil destruction within 7 to 10 days. It will go that fast. So I'm not saying this is what's coming. I'm just saying that with the level of economic tsunamis that could potentially come from all of these economic events I've laid out for you that are planned to come now in June and July, it makes logical sense to just be prepared in the event of, in case of, not because we expect it to happen, but because we want you guys to be prepared. And don't be distracted by the summer months. Make sure you keep your eye and your ear to the markets and what's going on, even if you just check up with crashes and taxes on a weekly basis, just to kind of pop in and see where the world is headed, because there's a lot of stuff. And I can't wait till information is coming out so that I can actually even give you guys more for information. There's so much that's coming. But until it does, it's just like, you're not going to know what I'm talking about. So it's just pointless. So I hope you all have a great week. It's the end of May and the beginning of June and the beginning of the beginning. And so that is so exciting and potentially scary, but you know what? We'll get this together. Take care, everybody. Until next week. Bye-bye.